Welcome to the Neurobiz Podcast channel. Today's episode is a practical one. No theory overload, no hype.
Just a simple question. If I had $1,000 to invest today, what would I actually do with it?
And more importantly, why I do it that way.
Yeah.
Because investing isn't about copying someone else's picks. It's about understanding asset allocation, risk, and decision making, especially when you're starting small.
Yeah. Let's clear something up right away. When you're investing $1,000, the biggest decision isn't which stock you buy. It's how you divide the money bet, also known as asset allocation. Classic asset allocation research, including work by Roger Gibson, shows that how your money is allocated across assets explains more long-term results than individual security selection.
Right. In simple terms, deciding how much goes into stocks, safer assets, or cash matters more than guessing the next big winner. Before investing that $1,000, I would ask one question. How would I feel if this dropped to $700 in a market downturn?
That's risk tolerance, not a quiz score, but an emotional reality. Daniel Kahneman's research shows that people feel losses about twice as strongly as gains. So if volatility makes you panic, your strategy needs to respect that. The biggest risk isn't the market, it's you selling at the wrong time.
Right.
So here's how I'd think about the $1,000 with it. Assuming a beginner with moderate risk tolerance. First, I wouldn't put it all into one stock. That's concentration risk, and it turns investing into a bet on a single outcome. Instead, I'll start with
Broad diversification using ETFs. For example, around 70-80% into a broad market equity ETF.
That's a great strategy for building long-term wealth. I totally agree.
Around 20-30% into something more stable ASIO, like bonds, a balanced ETF, or even holding cash if volatility scares you.
Yeah.
This structure reflects classic asset allocation principles, growth assets plus stability assets.
Exactly. It's about hedging your bets while still chasing those returns.
Yeah.
Let's talk ETFs versus individual stocks, because this is where beginners often get emotional. Buying a single stock is a high confidence bet. You're saying, I believe this company will outperform.
That's exactly it. It's a conviction play, putting your research to the test.
Yeah.
ETFs, on the other hand, are probability plays. You're saying, I believe markets grow over time, even if individual companies fail.
Annie Duke's Thinking in Bets teaches us that good decisions are about probabilities, not certainty.
Right. That's so important.
ETFs embrace that idea. They don't require you to be right about one company, just reasonably right about the economy over time.
Exactly. And that's why they've become such a staple in long-term portfolios.
Here's where psychology matters. Kahneman showed that humans suffer from overconfidence,
Recency bias, loss aversion.
which is why beginners often chase hot stocks, panic during dips, or overtrade small portfolios.
Yeah. A simple ETF-based allocation protects you from yourself more than from the market. I wouldn't day trade.
That's exactly it. It's about minimizing the behavioral risk.
Yeah. I wouldn't try to time the market.
Yeah.
And I wouldn't expect the $1,000 to change my life overnight.
Absolutely. I completely agree with that.
Because the real power isn't the first $1,000 something. It's building the habit, the discipline, and the framework. And
so if I had $1,000 today, I'd focus on smart asset allocation, respecting my risk tolerance, using ETFs for diversification, avoiding emotional decisions.
Because investing isn't about being brilliant. It's about being consistent, rational, and patient.
Yeah, exactly.
That wraps up today's episode of the Neurobiz Podcast channel. If this helped you think more clearly about investing,
share it with someone who's just starting out. Thanks for listening, and we'll see you next time.
We'll see you next time.